I have made videos covering this topic before, but a lot of people have been asking for an updated version considering all of the price changes and changes in general market conditions since then. And the big thing which has intensified over the last couple of months is asset price inflation. The government and their consumer price index are still denying that inflation is a problem. In fact, by their own measure, inflation is still below target levels, and it says that we need more money printing and lower interest rates to create that inflation. But one only has to look toward the asset markets for evidence of an incredible run of inflation over the last 10 years, which has intensified to a considerable degree over the last few months. The truth is, inflation doesn't always spread itself out equally, and advances in technology which facilitate higher productivity and the consistently decreasing cost of technology, as well as outsourcing and automation, is what is keeping the prices of many consumer products low, not the government's sound economic policy. If it weren't for the huge leaps that industry is making in the development of cost-reducing technology and processes, we would almost surely be seeing a lot more inflation in consumer prices. But you can always tell the real state of inflation by looking at investor behavior, and right now everybody from those in government to the retail investor right up to the hedge fund manager is worried about inflation. And people are buying assets like stocks and real estate and gold and silver and other commodities, and now crypto as well, in order to try and protect themselves and their portfolios from the erosive and portfolio-destroying effects of inflation. In other words, everybody knows that you can't print as much money as you want or artificially lower interest rates without any kind of repercussion. But yet we all tend to pay lip service to the CPI and other inflation indicators, and pretend as if we are not already experiencing hyperinflation in certain parts of the economy. And so one of the big changes has been an increasing number of people coming to this conclusion, and actually seeing the effects of inflation in their day-to-day lives and coming to crypto because of that. And so the whole crypto market has seen a substantial uptake because of this behavior. The second factor which has changed a lot is the staking yield of VET. Back when I made that video, I was earning a staking yield of around 5% per year, but now I'm earning around half of that. In other words, my staking yield has fallen by around 50%. And that's not necessarily because the income-producing power of VET has been diminished, but rather that the price has risen so quickly that the yield hasn't been able to keep up, which tends to be what happens during periods of extreme price movement. Yields are always behind price, but I personally expect the yield to normalize again as and when the market begins to normalize itself, whenever that happens. As for VTHO, the price hasn't actually changed very much at all, and as of Friday 16th of April, the date of recording this video, VTHO is down by around 10%, which may turn out to be a good entry point for a quick turnaround. The reason for making this video was to talk about VET versus VTHO, and which I thought was a better investment, but the truth is both currencies offer their own value proposition and have their own risks, and are therefore preferable in certain situations. In the last video, my personal preference was leaning on the side of VET on account of its healthy staking dividend, but now that the yield has fallen by around 50%, that particular advantage has been reduced. VTHO, in my opinion, still definitely has better potential for a quick gain, but it also may fall a lot more if the market were to crash tomorrow. Generally, I think that income-producing assets like VET tend to perform better during the bear markets than assets like VTHO, which don't produce any passive income. The reason being, during bear markets there is naturally less price movement, and so investor focus leans towards assets which produce an income. And we have to also understand that when prices fall, yields actually increase. If the entire crypto market were to crash tomorrow and the value of VET were to sink by 80%, and I'm not saying that I think that this will happen, but anything is possible, and if it did, the dividend yield of VET would increase 5 times over, as the asset price would then be 5 times lower. But an asset which produces no income at all will still produce no income, and therefore there is no safety net in the market crashing, and the only gain that can be had is through price appreciation. But having said that, those assets tend to perform much better during bull markets, because they tend to be undervalued during the bear markets as more focus is placed on the income-producing assets and less on growth assets. And combined with its lower market capitalization and therefore better ability to multiply in value more easily, I think that if market conditions continue to be good, VTHO will likely outperform VET. But if conditions are to reverse course at any time, I think that because of its income-producing capability, which acts as a kind of safety net and a steady stream of income that can be reinvested at the lower prices, VET will be the better performer. My personal guess is that the market will continue to do well for a while, and I don't know how long that will be. But for now, in my view, the macroeconomic conditions which are perpetuating and driving a bull run in the crypto market do not seem to be slowing down but only intensifying. But that's just my personal view. Let me know what you think in the comment section below, and thanks for watching. Also, if you're not yet subscribed to our channel, we have a lot more VeChain content out on a daily basis, as well as general investment content as well, so be sure to subscribe for that.